Good to see you, Jim. What do you mean by that?
Well, I mean, Kelly, that I think that there's two really good things that are one that's already happened, one that's just happening that I think are going to moderate inflation. And neither one of them depends on what the Fed's doing right now or will do. Um, if we look at economic policy, there's this idea the Fed's just started tightening, but the reality is we've had significant policy tightening going on now for almost a year. And it takes about a year for that to really work. If you look at the real growth in the annual M2 money supply a year ago in March, it was 25%. Today, it's 3%. If you look at the deficit to GDP ratio a year ago March, it was 18.5%. Today, that's a little over 9%. If you look at the 10s to 2s yield curve, a year ago March, it was 1.6%. Today, it's virtually zero. And if you look at what the dollar has done from last year lows, it's up about 10%. If the Fed was behind this type of monetary reduction, this type of fiscal reduction, this type of dollar advance, we'd all be much calmer that inflation was going to moderate. And I think it will. It takes about a year. We're just now going to enter that window where the tighter policies of the last year will start to help. In addition to that, I still think a big chunk of this excess inflation rate has been and is the pandemic, a unique restriction on the supply side of the economy. It's not just about overstimulating demand, it's restricting supply. And of all the supply chain problems we have, whether it's delivery times that are elevated or unfilled order backlogs that aren't filled or the lack ability to rebuild inventories, we really have just one supply problem, and that's an insufficient labor force. And the good news there is it's starting to pick up, and it dovetails exactly with this pandemic moving to an endemic. If I look at a year ago from August of 20 to October of 21, Kelly, the average annualized growth in the labor force was less than 0.5% a year. Since October, in the last 4 months, it's grown at 4.5% annualized pace. And that dovetails exactly with Omicron rolling over. If we're starting to get a fresh labor supply, we're going to see some of these supply restrictions ease at the same time that monetary, fiscal, yield curve, and dollar policies start to slow both inflation and overall economic growth. So I think the Fed isn't all that important, at least not nearly as much as people think.
Well, I think that you raise an interesting sort of cluster of points there, that an awful lot of inflation has less to do with what the Fed is doing and more right now to do with exogenous factors having to do with supply chain bottlenecks, the inability not just to get workers, but the inability to get sufficient trucks, sufficient chips, sufficient manufacturing out of places like China, out of other sourcing areas and so forth. So there's a lot in that area that has to go right to retard inflation, because it's not merely, though it is certainly contributed to, it's not merely growth in money supply, stimulus coming out of the federal government, low interest rates, the purchases of asset purchases by the Fed.
I agree, Tyler. It's a combination, but I still think the biggest supply restriction is not that we don't have enough trucks or we don't have enough cars. It's the people that build those. So it really comes back to the labor force, is my point. Mm-hmm. All the supply problems are tied to the lack of labor. And to the extent it's very encouraging in the United States that we're seeing the labor force participation rate climb now on a regular basis in recent months. We're seeing the labor force overall growing rapidly. Total job creation's been strong. I don't think that's a coincidence.
And that's happening because there is a receding of concern about COVID, number one. Number two, there is a rising rate of wages are going up.
Yeah, if you look at a chart of the wage inflation and lay it on top, the core labor force participation rate, they are the same chart. One of the reasons that participation went down so low is because the wage inflation went from 5.5% in 2000 down to 2% here a few years ago. And now it's back up to 5.5, 5.8. Well, guess what? You pay people more, they're going to start to come back to the labor force. And that's
we got to leave it there, Jim. Thank you very much. We appreciate your time today, as always.
Thanks, Tyler.
Jim Paulsen, Minneapolis.